All mortgages in Canada are the same. Think again. Choosing the right mortgage lender isn't about the best rate, it's about what fits best your financial situation. In Canada, the two main options are big banks and monoline lenders. And how do they stack up and which one is better for you? Let's break it down into simple terms. Big banks offer a wide array of financial services, including mortgages, and their aim is to be a one-stop shop for all financial services. Here are some of their advantages. Wide accessibility. You can probably recognize these banks based on color, and they're available pretty much anywhere you go. If you require an ATM in the middle of the night, you can find one. It's quite easy. 2, there's a trust factor. Because they're so well known and so heavily scrutinized, they have plenty of rules to abide by. Customers gain trust in them. And 3 would be the fact that you can bundle products together. Meaning that if you have a business line of credit, personal line of credit, personal credit card, mortgage, and an investment account, you can probably bundle them up and you can actually obtain some perks from having done so. More on this in a future video. By the same token, some of the cons are higher interest rates, stricter requirements, and cross-selling pressures. So if you have a line of credit or a credit card, you may be influenced to sign up for a mortgage because they have a cashback deal. We see that happen quite a lot. Monoline lenders, on the other hand, are institutions that focus only on mortgages. Unlike major banks, they don't offer checking accounts, credit cards, or any other financial products. And at the same time, they operate online or through mortgage brokers, with First National leading the pack. Pros of monoline lenders include better mortgage rates, so they compete with major banks, therefore it's easier for you to save money over time with them. 2, they're less severe and less strict when it comes to prepayment penalties or payout penalties. And 3, there's no cross-selling. Because they're monoline lenders, specialized specifically in mortgages, you don't have to worry about any of the products being set with them. Some of the cons, and we can draw a direct line towards the other major banks, are limited access, so they're not as popular, and there's no face-to-face service most of the time. There are no HELOCs, so it's difficult to obtain a home equity line of credit. However, other products are available that you can pair and work with. And by that same token, they aren't as popular. Because they're not as popular, it is more difficult for regular people who are not in the financial world to trust them. However, these institutions exist and they're vetted by regulatory bodies. And so let's take 2 examples. One, the example is of Zach, who is a budget-friendly client. Budget-friendly meaning he wants to keep his mortgage affordable, so we look at the best options for him, and compared to the banks, he goes with the monoline lender because they have better prepayment privileges, he saves on rate, and in case he wants to break the mortgage earlier, it won't cost him as much. This is the best option for him. Example 2 is John. John needs flexibility. So he foreshadows in the future needing a home equity line of credit or HELOC. Therefore, he signs on with a major bank. Choosing between a monoline lender and a major bank depends on what matters most to you. If you're looking to save money and have a flexible terms, you may want to go with the monoline lender. But if you're looking for more flexibility and face-to-face activity in order to be able to manage mortgage and potentially a HELOC further down the road, you may want to consider a major bank. There isn't a one-size-fits-all answer, so if you have any questions, leave them in the comments below. I'd love to hear what you have to say and what option fits best for you and how I can help you align yourself with your next mortgage so you can grow your portfolio. Until next time, stay informed.